Okay, hello everybody. How are we going? We're just going to wait a few moments while we let everybody file in. As you all probably know, um, nobody ever seems to arrive on time for a webinar. Luckily, myself and Tom have. How you going, Tom?
Yeah, doing pretty well, Liam. Excited to wrap up the year, both in this webinar and in general.
I was going to say, you excited for today's webinar or for the upcoming holidays?
Bit of both, bit of both. It's good to look back over the. It's always important to reflect on the year that's been. And this is my last presentation for the year actually. So it'll be not a nice way to finish it off, and then I can relax for a little bit and then start focusing on next year, I guess. How are you doing? How's your year been?
Yeah, very, very good. I moved temporarily to Bangkok, so that's been pretty good. I've been here since around about August, so that's pretty exciting. Surprisingly, something that I've noticed, they take Christmas very seriously here in Bangkok. The decorations are out of this world.
Oh, really? There you
Yeah,
go.
the Christmas decorations are so extra.
I wouldn't have thought that. It's pretty cool. Are you
Yeah,
staying over there for Chrissy? Are you popping back at all?
going to Chiang Mai for Christmas.
Oh wow. Okay, that'll be fun.
Yeah, so that's going to be pretty nice. I'm pretty excited for that one. Do you have any plans?
I'm just here. My girlfriend's family is visiting actually. They're from the States, and they land
Yeah.
here on Christmas Day for 10 days. I haven't actually met them in person before, so I'll be pretty preoccupied in Sydney entertaining them, I'm very excited for. Should be fun.
Yeah. Wow. So you're meeting them for the first time.
Yeah, they literally land Christmas Day. I'll pick them up from the airport and actually coming to my family Christmas. So it's all going on. Wish me luck.
Yeah, I was gonna say, mate, that is intense. I'll keep everything crossed for you. I'll be thinking of you on Christmas Day. We still have a few people. We got a few people show up. We'll give them a little bit more time. So I know that as well. We've sent out the link to everybody, telling them to register if they're going to watch the recording later. So we won't give them too much more time, just another 2 minutes or so, and then we'll get stuck into it. For everyone that is here, can you hear me? Can you please drop us your favorite emoji or a hello or something into the chat, just so I can see that you can actually hear us, that you are here. Oh, it's not looking good.
Just us having a catch up.
Yeah, no responses yet. Let
Is
me.
this your last webinar or event for the year with Fox and Hare, Liam?
There we go. Thanks, Alison. They can hear us. We've had a hand raised. And yes, this is my. Oh no, it's not. We have the equivalent tomorrow with our members who are invested with Vanguard as well. But so I've got today and then tomorrow, and then all the presentations are over. Although I don't doubt that this will be the best presentation of the year, Tom.
Oh, thank you. No, I'm gonna watch the Vanguard recording. You better not say the same thing before theirs.
Yeah, they are both going online, so I have to be careful. Maybe I need to
Might,
edit it out.
you might have to cut out this intro.
Yeah.
Fair enough. Fair enough.
Yeah. Just while we're waiting, so I will get stuck into the kind of the why of we're here today. Just we've got quite a few people in the chat now, so we'll get started. And I think it goes without saying that this year has been a bit of a wild ride. Starting, I think really we knew that it was going to be a bit of a wild ride when we were coming into it. I mean, President-elect Donald Trump is always going to have a few question marks around what's going to happen. He's a bit of an erratic fellow, but I guess it was Liberation Day when things really started, and then from there it has just been crazy after crazy after crazy, and
Mhm.
ups and downs, especially in the market. And so we really wanted to get our members together with you today, Tom, and just get the word from Betashares, a little bit of information about what's happening. Because when they see the numbers in their portfolio, we really want to see kind of the why behind them, what's happening, and also what might be coming in the future. So I think this is a pretty great way to finish off the year with that recap. And so today's session, we're going to start with a briefing from Tom. So that will run for about 15 to 20 minutes. So Tom's prepared an awesome slideshow for us. It's going to talk through everything that's been happening throughout the year. Um, I would like everyone to please drop any questions that pop into your head, either into the chat or into the Q&A. We've got a lot of time after the presentation. We'll have 15 to 20 minutes at the end of the presentation for questions specifically. So if there is anything that pops into your mind, please do drop that straight into the chat. Also, if you see a question in the chat that you either agree with or you'd like to know more about, please don't forget to upvote it or add an extension to the question into the chat as well, and we will try and get to that. So I think that's really important. Remember, we are here today to help you guys. We want you to understand what's happening with your portfolio, and so it's going to help if you do ask those questions. And Tom, with that, I'm going to hand over to you to start presenting. Is that okay?
Yeah, it's perfect. I'll just share my screen. Bear with me for 1 second.
Fantastic.
How's that looking there, Liam? All good?
Then just jump into full screen, I reckon, and we're even better.
What are you seeing at the moment? Is it not full screen?
It's
The physical.
the slideshow, the PowerPoint.
Okay. Okay. Bear with me 1 second. Just let me just share that screen. All right. How is that?
Perfect. There you go. Beautiful.
Fantastic. Great, great. Well, yeah, thanks everyone for joining the webinar today. Hope everyone's doing all right this time of year, particularly with what's gone on this week. It's been a pretty heavy week here in Sydney, Australia in general, but yeah, everyone's doing well first and foremost. Yeah, as Liam mentioned, pretty keen to talk about what's happened in markets this year and the economy for a pretty high level, and then dive into a few of the funds that Liam and the team use of Betashares. Just firstly, important to disclaim that everything I talk about is general in nature, doesn't take any individual circumstances into account. And just quickly, for those who you might be familiar with Betashares, because Liam and the team have put you into some of our various ETFs, but just a bit broad on the company. We're an Australian-founded ETF company, a really great Australian success story. Actually, we now manage quite a significant amount of FUM of Australian investors' money, and we also have over 1 million trusted Australian investors investing in our products. So yeah, thank you for Fox and Hare, and also the clients' continued support within Betashares. Yeah, a few sections today. I'll start with a recap, a few things about what I'm looking ahead for, and then an investment review. But let's dive right in. I mean, throughout the year, in my role as an investment strategist, I spend my year, every week and every day looking at what's going on in global markets, looking at the news flow, writing insights into the 100 various different funds we have. So getting to the end of the year and looking to recap that, there's so much that goes on day to day. But as I take a step back, I think this year there was probably 4 or 5 really key narratives that drove market sentiment over over various parts of the year. And the first one of those, as you already alluded to, Liam, was the Trump winning the election in the US, which has actually happened in, I believe, November of the prior year, but he was inducted in January, of course. And the year, and what I've got and how I'll frame this is just some of these key events on top of a price chart or a total return chart of a globally diversified equity investment. So showing the total returns in percentage throughout the year of a broadly diversified portfolio in American shares, developed market shares, emerging market shares, and Australian shares. So it gives you a picture of how the world's equity market is going essentially. And we can see we started pretty volatile, particularly following Trump's induction. I'd say there's a lot of uncertainty around the impact that Donald Trump's regime would have on global equity markets. I actually went back to my first presentation from this year, and this was one of the first slides that I had in that presentation. Because a lot of the policies Donald Trump has have very mixed potential impacts on both the US and global economies and US and other equity markets. And so it really, in our mind, came down to what order Donald Trump would look to implement each of these different policies in, and the magnitude of those policies. And so it's fair to say there's a lot of uncertainty in markets in those first 3 or 4 months around how impactful each of these policies would be. And then, of course, we got to Liberation Day, which was probably the Actually, it's definitely the biggest day or the biggest week in markets for 2025. It was almost the peak uncertainty. If we were uncertain those first few months about, how all these, immediate actions Donald Trump put in place and talks of trade wars and I guess escalating geopolitical tension, this is when it really came to a head. Um, and as is often the case in market events like this, despite how sentiment is and how it might be reported, typically on days like Liberation Day, it usually is like as bad as it gets because there's huge sweeping proposals or implementations of pretty significant tariffs, much larger than we've seen in any of our lifetimes or in recent history. And that led to a pretty significant market sell-off. We can see there at the bottom that globally diversified equity portfolio was down about 9%, 9% at the worst part of this year, which is pretty much after that announcement. Now, sentiment was pretty poor then. A lot of economists said if these tariffs stay in place as they are, it will likely cause a US recession, just because of the increased tax that tariffs essentially are on consumers. And the outlook was fairly bleak. Now, almost immediately, we saw Donald Trump, reneging on some of those tariff policies and saying he's looking to make deals with other countries. So we're almost priced in, or markets almost priced in the worst possible scenario at that point in time, and then started to climb quite significantly as, from that low point, we started getting better news in terms of trade deals or actual lower tariff rates, or things aren't going to be as bad as expected. And that's when we really entered probably the main phase of this year. Also, just a comment on the tariffs, I guess. They are still like very significant. I think economists and even myself, I'm surprised at how little of an impact they seem to have had on things like consumer spending, on things like inflation within the US. A lot of economists and strategists expected a pretty big inflationary pulse from this, additional tax on US consumers in that third and fourth quarter, which really didn't come to the extent that was expected. But in saying that, they are still a massive, there's still a massive difference from what there was a year ago. And I wouldn't be surprised if it still has some economic impact down the line that's greater than it has been. But I think part of the market's recovery is the fact that these tariffs came in place, the government's taking in a lot more tax revenue, and seemingly, at least in the headline data figures, there hasn't been too negative of an economic impact, particularly on the US economy, as well as its trading partners. We've seen a lot of trade just being diverted away from the US, like from China to other places. So not as bad as feared. The tariffs and also, the initial rates were pulled back. And so that really allowed markets to not only recover from that drawdown pretty quickly. I mean, if we look at the chart from that low in early April, markets have recovered to the previous high in less than a month or about a month, which is a pretty stark recovery. And actually, through the remainder of the year, we saw a pretty strong bull market. And look, obviously, there's a lot of news flow during this period in terms of escalating and de-escalating trade tensions between China and the US. There's various news in the Australian market about the big banks rally and resources. Obviously, a lot of pretty unfortunate geopolitical tension going on. But I think the main narrative that allowed markets to continue to grow so strongly during this period was the earnings of the big tech companies in the US. Every time there was economic concerns, every time there was fears around tariffs having impacts, we obviously get quarterly earnings updates in the US. And the quarterly earnings growth remains really strong in the US market, led by Nvidia, but also the other hyperscalers like your Apples and Microsofts of the world. For companies of their size, they're still experiencing earnings growth of 20% per annum on average. Like, it's absolutely remarkable. It's like nothing we've ever seen before in markets from other market leadership. So they really are the biggest companies, and they're growing their earnings at the fastest. It's remarkable. And that really allowed markets to, I guess, climb this wall of worry, and took us from -9% to +14% on this very broad globally diversified portfolio. So a swing of 23%, which is massive. And if you look at like more uh, specific indices, like a Nasdaq 100 index, for instance, which tracks the 100 largest technology companies essentially within the US, we saw a swing of close to 40%. So quite remarkable. But for all that news and for all that turmoil in the first, I put there about 3 and a bit quarters of the year, um, the diversified portfolio doing pretty well. I'd say 14% is above average. You're probably looking at around 10 to 12% on average for a broad global diversified equity portfolio like this. So it was a pretty good year up until that point. And that took us into the last phase, which really was the past 6 weeks or so. Sorry, again, I actually illustrated this point. So this is my point around the really strong earnings growth or profit growth of these big technology names. What I have here on the x-axis along the bottom is the profit growth of various tech companies in the US. And on the y-axis, I have their total return or the investors' return from investing in these names. And let's just focus on a name like Nvidia, the biggest company in the world. Year on year, Nvidia has grown its profits by around 60%, which is absolutely incredible for a company of its size. And its price growth over the year had only been about, let's call it 30, close to 40%. So it actually grew its profits faster than its price return, which implies that actually the valuations for that company would have compressed a little. And so that's the main point. Like if you draw a line, the axes aren't exactly aligned. Apologies for that. But if you draw a line along here, any company below that line is actually, growing its profits faster than its price is appreciating, which means valuations aren't actually under as much pressure as has been potentially feared. And that's what I believe allowed markets to grow without things getting too bubbly or too toppy or people getting too alarmed about valuations. So that profit growth story is still very strong. I guess a question is, for how long can companies of that size with profits of that amount keep growing at 20%? Because as I said, it's never happened before in history. I mean, they've been doing it for a little while now, but that's a bit of an existential question that the market has. And that's what really drove this final part of the year. Bit more volatility, a bit more choppy, downways, sideways trading. Questions around the sustainability of those big companies and their earnings growth. And the reason I focus so much on those companies and so much on the US in my analysis of the broad global market, if we look at the MSCI ACWI, which is a broad global index which includes all companies, developed companies, emerging market companies, in that index, the US makes up close to 70% of the weight of the index. And the top 5, top 10 technology names in the US market make up 50% plus of that market. So they have a huge amount of influence on even a broadly diversified portfolio. So that's worth mentioning. But yeah, so to end the year, we had some concerns around the sustainability, not just of the big tech's earnings, but also of, will they be able to monetize and make profit from all of the AI capex or capital expenditure they're spending? Because these companies, biggest in the world, they've got huge billions of dollars on their balance sheets. And the question is, how do they spend those? In years gone by, they've done a lot of share buybacks. They just buy shares back off the public market. That helps the stock price rise. Essentially, it's like a return of capital to investors. This year, they've taken that same money and actually spent it on future or current expenditure to try and grow future earnings. We're talking about maybe close to $1 trillion of capital expenditure by 2029, which is, again, we're talking historical figures here. And the market is asking, how are you going to return a profit from $1 trillion of spending? Because it's just like pretty incomprehensible. And that's kind of one of the main philosophical questions that remains in markets. Can these companies reap the rewards from their massive spending at the moment? A few points in that. I mean, a few reasons why for those big tech names in particular, there are more speculative parts of the market, but focusing on the big tech names, I'm not as fundamentally concerned about that question. Number one is most of this spending so far have just come from their cash balances. Like I think I did the data at some stage this year, but these companies, they generate something like 450 billion US dollars per year in free cash flows. So they've got $450 billion per year they can use to, give back to investors or to invest. And so far, the vast majority of their spending has come from those free cash flows. So it's not like they're extremely highly leveraged and taking on huge amounts of debts. That's definitely a positive. These companies also sit at the forefront of like modern technology and sit at the forefront of a lot of the technological innovation we've seen over the past decade. Very similar questions to a different scale, I will say, were asked 10 years ago about cloud computing. There's a really great article I sometimes use in presentations from Bloomberg. It was about 11 years ago now, saying, is Microsoft near the end of its useful life? And the article said, this company, it's got the, enterprise software, it's stored, on a computer on a computer directly. And they're spending so much money on this, future cloud computing division. It seems like this is a last ditch effort to try and grab onto something that will get them future earnings. And for a long time, there was huge capex without reward from cloud computing. But now that division for a lot of these companies is their biggest profit driver. So they've been through cycles like this before. But the caveat I keep coming back to is, I will admit, and this is unprecedented in terms of the amount they're spending and the amount of profit they need to earn to make it pay off. So that's a pretty, still strong fundamental question that we have to consider. And they are now starting to, I guess, test the bond market and test the credit markets. So issuing more bonds now. And we'll have to issue more bonds if they want to spend the amounts that they want to. A lot can come from cash, but they wanted to test the bond markets, and testing the bond markets is a very different test to testing the equity markets. If you buy a company's stock, you've got infinite upside. If that stock does really well, you can get 2 times your money, 3 times your money, or 100% return, whatever it is. In the bond market, and if you're a bond buyer, it's a different question. If you're buying a company's bonds, the only question is, will I receive my interest payments back? And will I receive my principal payments back? There is no further upside than that. So it's a much more stringent test issuing debt on the hopes of future AI earnings compared to issuing equity. And I think we're at a very interesting crossroads, and really the bond markets may be the ones who determine what the appetite for the big tech spending is. But this is really a story that's evolving right now, and a story that I'll be spending a lot of time on over the next few weeks digging into. So things to watch there if you are more markets orientated are things like credit spreads, how much a bond buyer's demanding in terms of the return of the bonds. It kind of indicates how risky the bonds are, and that'll be the bond market's indication of how happy or unhappy they are with these companies and their spending plans. Look, at a high level, that really those are the big stories of the year. I mean, in between those stories, there's a new story every single week, I'd say. But those are the big ones in my mind that really drove market sentiment and drove global markets. With that, I don't know, I can see there's a few things in the chat. I'm not sure if there's any questions you had at that stage before I talk about my outlook for next year, or can jump in if not.
I think we're good. We were just handling some problems with the chat. So I'd just like to remind everyone, if you do have any questions, please drop them into the chat and we will jump onto them at the end. Otherwise, keep it rolling, Tom. It's fantastic.
Perfect. Easy as. So yeah, that's my reflection on it was. Now looking ahead, I have posed just 2 questions, I guess. One for the economy and one for markets. So in my mind, one of the big questions for the economy, and there's a lot, but just to try and keep things relatively high level for the economy next year, is actually around interest rates, both here in Australia and in the US, because the decision-making process for interest rates, a lot of factors go into that. Most prominently is, of course, inflation and unemployment. But the direction of interest rates also has a huge impact in terms of impact on economic growth, in terms of impact on currency, etc. And what is really interesting to me at the moment is what I have on screen here is just what the market, what people investing in the market expect interest rates to be in Australia in the orange line, and in the US in the grey line in 1 year's time. And there's a really, really big divergence here in terms of what markets are expecting to play out. Donald Trump has actually said he wants the Fed funds rate down at 1%, which is much below the market's expectations. But the reason this is so interesting to me is the market's expecting rate hikes in Australia from this point. We had a meeting just last week, an RBA meeting, which was fairly hawkish. The RBA governor came out and said, we did not discuss, or we didn't even think about cutting rates, and we didn't discuss what would have to happen for us to cut rates going forward, which surprised a lot of people. We obviously had started a rate cutting cycle, which is beneficial to consumers and it's good for mortgage holders. But just given the inflation outlook in Australia, the RBA seems to think that there's no room for cutting and there might be room for price hikes, which would mean we have a very shallow cutting cycle. Whereas in the US, I think unemployment is a much bigger swing factor. And also just the influence that Donald Trump is trying to have over the Fed is playing a big influence. So to sum up, my thoughts here, I think we'll probably land somewhere in the middle. I think the inflation numbers in Australia will remain steady, if not come down. I think there's anomalies in the fees we're seeing at the moment. So I'm hoping that the RBA cash rate at least stays the same, if not potentially a cut later on next year, if inflation does come under control. And the US, it's really hard because of the influence Donald Trump's trying to have over the Fed. And also we've got a new Fed governor being elected by Donald Trump early next year. So that's a much, much more muddled picture. But I imagine these two rates will end up somewhere closer together as they typically have historically. But if they don't, and if we see the US rate come down a lot lower than the Australian rate, what would I expect to see? I'd expect to see the Australian dollar to appreciate under those circumstances because of the interest rate differential. It's a key driver of currency rates. And that'd be a big impact, I think. One of the bigger impacts would be on the currency. The second thing, if I'm thinking about markets, what's my main question about global equity markets next year? And the main question will remain, in my mind, and the main discussion will remain around the top of the market, the big tech names, and is there a bubble, or could there be a bubble in the US equity market, or is this similar to the dot-com crash? Obviously, very similar circumstantially. Big capex rollout, a lot of excitement about a future technology, questions around the profitability of it. But at the moment, I don't think there's an equity market bubble just based on valuations. What I have here is the valuations of today's tech giants. This is looking at on a price earnings basis, but the earnings over the next 2 years. So it does extend the time horizon to what you typically see in a PE. But it's still very comparable to, I'm using the exact same data to compare that to the top tech names in the 90s. And we can see it's a very different picture in terms of the valuations. And ultimately, for an equity market bubble, we probably need to see valuations at much higher rates than here, levels than here. Now, that is different from a capex bubble. Is there likely going to be overspending on the rollout of parts of this rollout? Almost certainly. It's a newly developing technology. There's trillions of dollars expected to be spent. We don't know the eventual end use cases and how much compute you will need. So given those circumstances, I definitely think there'll be areas where there's overspending, but that is distinct from an equity market bubble. I think that's an important distinction and something I'll keep my eye on over the years to come. Now, I guess within that broader economic context and market context, we can take a look at the Betashares investments that Fox and Hare have predominantly used this year from the Betashares suite. And really the Fox and Hare team, they use a selection of ours, but I think the majority of clients are within our diversified portfolios, which the line chart we looked at when we were reviewing markets last year is actually the line chart of our DHHF ETF, which is this ETF here. It's just a diversified all growth ETF. So you can see the breakdown here. It's got a mix of US equities, developed market, ex-US, emerging market, and Australian equities. It's all equity investments. So typically better for longer term accumulators, and the type of fund, and with a very low fee, the type of fund that allocating to frequently, monthly or bi-weekly dollar cost averaging, it's very well suited to doing that. If we look at the breakdown of each of the ETFs underlying this fund and how they performed this year. So here's the fund on the left-hand column and the weight that that fund had in the portfolio. What that individual fund returned over the year, and ultimately, based on those numbers, how much that fund contributed to the overall return, which is around 12%, which again is a pretty good return for a diversified portfolio over the long term. We can see some standouts, though, particularly the developed world ex-US, this 23%, outperformed the US allocation by quite a bit, actually. And I'll come to a key reason why that was the case in my next slide. The Australian market returned around 9%, which is pretty in line with the long-term returns of the Australian market. It tends to be, or has tended, sorry, to be lower over the past 15 years than global and US markets, just due to the nature of us having more financials and resources which haven't performed as well on the resource side over the past few years. And emerging markets had a really good year actually as well, which I think is a theme that could continue into next year. But I'd say the biggest divergence here is between the US stock market, which is this top line, and the global developed market. And a lot of that actually has to do with currency. So a big theme in markets this year was US dollar weakness, particularly in the first half of the year. I think I wrote a piece on this, and it was the worst first quarter for the US dollar, I think, ever, potentially, in terms of its weakness. And this has a big impact on our portfolio returns. So since we're Australian investors, we take our Australian dollars, we invest them in the case of the top line there, the Vanguard total stock market, which is the total US stock market. We convert those US dollars and invest them in US shares. We still value our holdings in Australian dollars. So if the US dollar depreciates over the course of the year, as it has done, when you convert that back to Australian dollars, you actually are impacted by this depreciation of the US dollar directly by the amount it depreciates by. And so I guess against the US dollar's broad currency mix of trading partners, it was down 10% this year. Against the Australian dollar, it's actually only depreciated about 4% this year. So what that means is if we took currency out of this equation, that VTS would have returned around 14% rather than 10%. But currency really impacted the returns of US equities in Australian dollar terms last year. And this second line, which has a lot of European and Japanese stocks in it, was actually boosted by the US dollar weakness. And so these two, actually, once you strip currency out, were very close. The underlying stock markets returned a very similar amount, but currency plays a big role for Australian investors in overseas investments. Now, over the long term, which is what a product like this is pretty suited to, a lot of investors don't concern themselves too much with currency because currency goes through cycles. And just as the US dollar weakened by 10% this year, there can be quite long cycles, but over the long term, it tends to mean revert. And so sometimes if you try and, yes, pick these moves in currency, if you get them wrong, it can really cost you. If you get them right, it can benefit you a lot, but it's very, very tricky to do. So a lot of investors just accept that, okay, some years the currency will work against me, some years it'll work for me, but over the long run, it shouldn't have too much of an impact on my portfolio returns. But yeah, just an interesting observation. But all said and done, that 12% return is pretty good for a long-term investment. The second set of funds I wanted to talk about were also a diversified range of funds, but are ethical diversified range of funds. I think a lot of the Fox and Hare investors also invest in these ethically diversified ETFs, very similar to the conceptually to the DHH ETF we looked at before. However, the building blocks for this fund, the the ETFs we use, the Australian bonds, the international bonds, and the equity portfolios are ethical ETFs. So they will screen the broader market. Let's take the Australian fund, for instance, which is fair. It takes the ASX 200, and instead of investing in every company in the ASX 200, it goes, okay, which of these companies have really high, fossil fuel exposure? Which of these companies are financing fossil fuels? Which of these companies are selling things like tobacco or operating poking machines or involved in controversies? And it puts those companies to one side. It doesn't invest in them, and invests in the remaining basket of companies within the Australian market. So you do end up, when you use a stringent ethical screening process like DZZF's underlying holdings use, you do end up with a investment profile that is quite different from the broader market, particularly in the case of the Australian market, just given how much of our market is made up by resource companies, by big banks which finance fossil fuels. So you do end up with a different market exposure. And again, just like my point on currency going through cycles, the different types of companies that drive market performance also go through different cycles. And what we saw this year, and this is using the Australian market as an example, what I have on screen here, each of these companies, look at the company names as a starting point, CBA, BHP, NAB. These companies are about the top, I think the top 14 or 15 companies that contributed to the ASX 200's performance over the year. So CBA was the biggest contributor to the return to the ASX 200, or the biggest positive contributor, followed by BHP, NAB, Westpac, so on and so forth. Now, when you look at these names, for ethical investors, a lot of these names would not be included in an ethical investor's portfolio. Each of the big four banks are the biggest financiers of fossil fuels in Australia. So if you're taking a dark green approach to investing in ethical investments, you would exclude them. Your BHPs, Rio Tintos, Fortescue's, North Star Resources, I mean, almost the rest of the list there are obviously big resource and mining companies, which also typically don't, make what an ethical investor wants in their portfolio. So unfortunately, this year, a lot of the growth in the Australia market came from companies that, would not be included in an ethical investor's portfolio. And this meant that compared to the broader market, ethical investments didn't do as well this year, both in Australia and globally, than the broad market indices do. And to take a step back and kind of look at what I mean by looking at the broader cycles, this year was pretty poor for a diversified ethical investments returns. However, the few years before that had been fairly strong for an ethical investment returns. And what that means is, if we think about the longer term and think about having better years and having worse years, over the past 3 years per annum, this ethical portfolio still has returned a pretty solid 12.4%, while still meeting investors' ethical standards. So a tougher year for ethical investments this year, but luckily, years before that, and I won't be surprised if years to come will balance that out. It's a pretty key takeaway when you're investing for the long term. When you're, let's say, dollar cost averaging into a long term, low cost diversified exposure, there will be up years and down years, but really the main principle to keep in mind is the continuing to allocate, continuing to dollar cost average in, and the market cycles will come and go over the long term. But that probably summarizes the main parts I wanted to cover today, Liam. I'll open to any comments from yourself or any questions I can help answer from the audience.
First of all, thanks so much for that. Who knew that markets and numbers could be so exciting? I really didn't think that we would we would ever be in a situation where all this stuff would be so exciting. But it turns out that 2025 was the year that it all came true. We don't have any questions yet in the chat. So just a reminder to everybody that is there, if you do have any questions, please drop them in. Otherwise, I do have some that I would like to ask.
Yeah, of course.
First of all, when we're walking away from today's session,
Mhm.
What do you think is looking forward into 2026 and presuming that there may be more volatility or who knows what's going to happen? What is the number one thing that you think everybody should take away from today's session?
Yeah, the main thing I'd say to take away, particularly for people who don't spend their day to day looking at financial markets, obviously spend every day looking at financial markets and trying to synthesize these, what can be fairly complicated topics into something digestible and understandable. But for clients, obviously in this webinar, they're already using a financial advisor, which is a great start if they're not involved in markets themselves. The reason being is, someone like myself, someone like your advisor, we spend the time looking at these things, worrying about these things. And there's so much, we've literally scratched the surface of what's gone on this year and the market panic and market noise. But once again, the tried and tested method of just staying invested, investing consistently, you would have turned out fairly well off this year in terms of that broad diversified portfolio we looked at. If you had panicked, if Donald Trump came in and everyone's got their own personal news, they thought the world's going to explode, you would have taken your money out, put it in cash. After Liberation Day, a lot of market commentators, a lot of active managers. So these are all passive ETFs. Passive ETFs performed significantly better than active managers as a cohort this year. And a big reason for that was after the Liberation Day announcements, a lot of active managers went, oh, okay, economy's headed for recession. This is just the start of it. We need to be careful. We need to take our money out. We need to sit in cash. We need to not be exposed to the US. Look at that rebound we saw, Liam. If you had parked your money in cash during that time, in a month you would have missed a 10% pop. In 2 months, a 20% pop. So markets are tricky. They're very complicated, even for investment professionals. And still, once again, the true and tested method of sticking to a plan, sticking to a diversified ETF, and consistently investing is what really, once again, would have helped to grow wealth this year. Not trying to be tricky with it. So I think that's the key takeaway. Again, it wins again in 2025. We'll watch on for next year.
Keep calm and carry on, basically,
Yeah,
is
that's
the
it.
is the theme of the day. Okay, perfect. And we have a question from Andy now as well. So he says, we've had lithium, GLP-1, which for the uninitiated is the drugs like Ozempic. Am I right? Yep. And
Yes.
now AI. And he wants to know, what do you see as the next broad thematic? What's coming?
Yeah,
Get your crystal ball out, Tom.
yeah. Good question. I do spend a lot of my time looking at, broader thematics. We obviously want to, as investors, at least long-term investors, look for big structural growth thematics, not thematics that are a flash in the pan. I think one of those that I see is a very long-term thematic, and maybe it's not as new as those. Lithium's come and gone over the years. I think healthcare will continue to see great innovations there with the evolution of AI. But I think in terms of like a really strong structural growth thematic that I could put my hat on for the next 5 or 10 years rather than a cycle would be cybersecurity. It's nothing new, but it's something that in today's context is just growing and growing in prevalence, growing in investments from the government sector, from the private sector. And I just think with AI, with the evolution of stronger advancements in all industries, even the healthcare industry, it'll be even more important. So I try to look for those really strong structural growth trends because it's very hard to pick. I'm sure next year there'll be some flash in the pan. Maybe it's quantum computing. There's a lot of talk around quantum computing. That's very hard to invest in at the moment. There's only a few pure play companies in the world. So I try to hang my hat on those longer term structural ones that I could, invest in now and know in 5, 10 years will be really, really strong.
Perfect. Thanks, Tom. Yeah, the cybersecurity one, it's not definitely not something that is, I guess, sexy, but the number of scams and the number of scammers out there really does, I think, demonstrate the need for that to grow, I guess, or the necessity that we're going to have to expand in cybersecurity. So yeah, that really, really makes sense to me. We have hit time for the day. So that is 45 minutes down. Uh,
Mhm.
For all of the members who are online, if I could please ask you, I have dropped a link to a survey in the chat. I know that everybody asked you to complete surveys, but this one is special because it does help me with my KPIs. So I really would love it if you could complete it for us. It's a few questions. It'll take you a couple of seconds, but also it'll help us improve your experience with Fox and Hare. And we always really are trying to get better for you guys. So if you could please complete that, that would be fantastic. And finally, thank you very much, Tom. Thanks for your time and good luck with the family arriving on Christmas. I'll keep everything crossed for you. I'll be thinking of you as I'm sitting next to the pool.
Thanks very much, Liam. Enjoy some time off.
I will do. Thanks, mate. Bye, everyone.